Friday to you. Carl, it's been a pretty busy week for us.
Happy Friday, everybody.
We had the big Stay-at-Home Millionaire Summit, and just, been a raging success, and thanks to all those who were able to join us.
Yeah, and we're making some monster moves in Prox Capital as well. So it's been a pretty interesting week. I always love the Friday YouTube lives. I think we've got a special little training thing we're going to do today, and then some awesome questions, Adam. And I love answering people's questions, as you know.
Yeah, oh, absolutely. Listen, it's been a great week, and we're glad to have all of you guys here, and certainly welcome. When you get on the line, definitely say hi in the chat. We love to hear from you guys. It's really what brings us the kind of joy and excitement from doing this every week. So drop in the chat, say hi. Glad to have you. Carl, you got any plans for the weekend?
I'm going to do some crazy cycling this weekend. Luckily, I don't have a big honey-do list this weekend, so I'm going to do some crazy cycling. My Oculus virtual reality headset arrived yesterday, so I'm going to be goofing around with that. And then, just hang with the family, and be my turn to cook some food, I think. So, no, I'm just looking forward to the downtime. It's been a wild week.
Yeah, I mean, it's I would say it's been a really wild week. Have you looked at your head lately?
I have.
Yeah. You shaved off all your hair, buddy. You wanted to look like me. You want to look smooth and slick and ready for action.
I wanted to look like you. I'll very, very quickly tell the story. So I had to keep my hair all nice for the Stay-at-Home Millionaire Summit. And then as soon as that was done, the following day, I was in my garden doing some work, and it's been so hot in the UK. It's been like 25 degrees, which for the UK is hot, especially in April. And my hair is all
for those at home, it's like upper 70s.
Upper 70s, yeah. So, and all the sweat running down my face with all my hair, and I just thought, you know what, I'm done. So I thought, I'm going to shave it all off. My wife wouldn't do it, so I did it myself, and it's not too bad.
No, I think it looks slick. I think you're streamlined for deals. I think you're ready for action. There's no doubt about it.
No frictional drag when I'm charging forward.
Slick.
Yeah.
But hey guys, absolutely glad to have you. Say hello when you get in the chat. Really looking forward to getting to your questions. Today is going to be really special. We're going to talk a little bit about the austerity measures that have been happening in the U.S. and then happening in the UK for those impacted by the coronavirus. So cross-pollination, what a great name. Morning, Carl. He or she likes the new look. They love the streamlined.
Thank you, guys.
Yeah, listen, I'd say you look right smart.
There you go. You see. Got my funky glasses on, shaved my head. What can I do?
Hey, we're just a couple of balding deal makers. It's fine.
There you go.
But no, looking forward to getting into some stuff today. So we just letting a few more people get on the line. But say good morning. We're happy to have you, or I guess good afternoon if you're coming from the UK. A lot of good stuff's happened lately, Carl. I mean, I know on the deal side, we're seeing just a ton of opportunity. We're seeing a lot of people really hone in and focus in on making good deals, and we're having calls with sellers who are busier than ever, but understanding the limitations of the seller market right now, and it's just making things really show up and have a good dialogue with them. So really happy with that. From the deal making side.
Yeah. And I know kind of the common misconception is all businesses are dying. Some of them are struggling, particularly in the hospitality industry. I wouldn't like to own an airline or a cruise ship right now, but with some of the things we're going to talk about the first part of this session, some of the government schemes that we're seeing both on your side of the pond and on my side of the pond, they're amazing, and it's going to give businesses, a war chest to trade through what we're doing. And then, like, I know next week in the UK, they're going to start announcing all the easements to the lockdown. They're going to be sending the children back to school. They're going to start opening businesses again. So by the end of May, I certainly think in the UK, we're not going to be back to normal. I don't think there will be a normal, but I think to all intents and purposes, a lot of the pain will have gone.
Yeah, I think it's been interesting. I know I've been reading some stuff on how schools are trying to figure things out here in the States, where they're going to try to have desks spread out in certain ways. And I don't know if they're going to have enough classroom space. It's going to be very interesting to see how they fit that. Not to mention, if you still can't hang out in groups of 10 or 20 or whatever the limit ends up being, how do you have a classroom full of children? Certainly a lot more than 10 in those classrooms. So anyways, we're happy to be here. Happy Friday, guys. And we're going to talk a little bit about the Paycheck Protection Program here in the US, the PPP, and the employee furlough system. Is that correct me if I'm wrong there, Carl?
Employee furlough scheme, EFS.
Scheme, thank you. Yeah. Yeah, absolutely. So we're going to kind of talk through those programs just a little bit today. What are they, and what the impacts are for businesses, and how we see that impact when we're looking at deals. Beyond that, we're going to have open Q&A. We've got a bunch of questions already in the mailbag. But if you guys have questions for us, now's the time to ask. We're really excited to be doing this, meeting with you, and we want you guys to feel like you can ask us while we're live. That's what we're doing this for. So
absolutely. So between the two of us, we have almost 45 years worth of deal making experience. I would say close on 450, nearly 500 deals between us. There's nothing that Adam and I don't know about buying businesses, growing businesses, selling businesses, whether it's from a psychology perspective, a process perspective, a numbers perspective, a funding perspective, a closing perspective. It doesn't matter. So if you have any interest in buying a business, ask your questions right now.
Yeah, absolutely. So just pulling up the questions here. So we'll get to those here in a minute. But first, Carl, let's just jump right into these schemes.
Yeah. So I think it's in the UK.
Yeah. Why don't you get started?
Yeah. So I know in the US they keep announcing these sums of money, and then they get taken up, and then they shut them down, and they start again. In the UK, there's none of those issues at all. It's kind of unlimited. I'm seeing nothing in the media about people, being denied access to it. So there's two main schemes that are in operation. The first one that launched, about 4 or 5 weeks ago, was the EFS, the Employee Furlough Scheme. So any employee that works for a business, the government is paying 80% of their income up to a maximum of £2,500 per month. So clearly, Adam, if you and I were employed in the UK, it wouldn't cover much of our income. But for the vast majority of the UK population, I think 95% of the people in the UK are earning £2,500 a month or less. So what the government does is they're paying 80% of that money, and then it's up to the employer if they are prepared to true up the existing 20%. So it only works where an employer is furloughing that employee. So they're saying, I'm sorry, you can't come to work, you've got to stay at home. But the government's going to pay 80% of your salary up to $2,500 a month, and then it's up to the employer whether they continue paying you the extra 20%. Most employers are, but some of them are not, and that's been a kind of really good scheme. And then the other scheme that's coming out on Monday, and this is a game changer. This is going to be awesome. It's called the Coronavirus Bounce Back Loan, the CBBL. And this is insane. What the government's doing, and it's phenomenal what they're doing, is any business that's trading in the UK, whether you're a partnership, whether you're a limited company, whether you're an LLP, doesn't matter. Whatever revenues you've generated, doesn't matter about profit, whatever revenues you've generated over the past 12 months, the government will give you a 25% interest-free loan up to a maximum of £50,000. So this is obviously not out there to help British Airways or British Gas or massive companies. It's there to help the vast majority of businesses in the country. So if you're if you're doing £200,000 a year or less in revenues, you're able to get £50,000 as an interest-free loan, and it's interest-free, I believe, for 12 months. So it's free cash. I know you and I were talking about this the other day. There's probably going to be some kind of mismanagement of this. You're not allowed to take out the money to buy a business. You're not allowed to take out the money to retire existing debt. But as you and I know, it's quite easy to kind of game the system and do that. But I think fundamentally, it's going to allow a lot of small businesses to trade through this situation, whether they're pivoting, whether they're furloughing, whatever they're doing, it's interest-free money.
Yeah, absolutely. So do you know, is it a 12-month term to repay the loan? Do they say? Or is that just
it's interest-free and capital repayment free for 12 months. Wow. And then it depends on how much money you borrow. But I think it's a 3 to 5 year repayment profile.
And that's only for businesses under 200K, right?
No, so if
you've got turnover of £1 million, you can still get that $50,000 interest-free loan.
£50,000. It's capped. It's 25% of your annual revenue or turnover, as we call it, but it's capped at 50K. So if you're £1 million a year revenue business, you'll still get 50K. If you're a £200,000 a year, you'll get 50K. If you're £100,000 a year, you'll get 25K.
Yeah, no, absolutely. Well, very cool. I think it's very interesting. So going back to the employee furlough scheme, so the government's going to pay 80% of their salaries up to $2,500 a month. So the government will pay $30,000 a year, and the employer has the option to pay the remainder, say that extra 20% or anything above that threshold. That's right.
So and the only rule is the employee has to be furloughed. So the employee has to be furloughed from their job, but it doesn't stop you going and getting another job. So I was watching Sky News yesterday morning early, and there was a lady on there who, very glamorous, used to be an air hostess for Virgin Atlantic. They furloughed the vast majority of their workforce. So she's getting her 80% of her salary paid by Virgin, who are being paid by the government. Because I don't think these people earn $2,500 a month. But then she's now out helping in a supermarket. So helping, replenish shelves and produce inside of the supermarket. So she's actually making more money now than she was as an air hostess. So she's getting her 80% of her Virgin salary, plus she's drawing another full-time salary working in a supermarket. So you're allowed to do that.
Yeah, so there's no limits for a furloughed employee to, say, find another job.
Nope. Because a lot of the supermarkets, a lot of the medical centers, a lot of the hospitals, logistics companies, all these sectors, Adam, that are booming right now, they all need temporary help. So all these furloughed employees, they're getting paid anyway. They're, getting 1.8 times their monthly income because some of them just want to stay at home all day and enjoy the weather. But now the weather's turned. A lot of these people are going out. And my stepdaughter Rebecca's doing the same thing. She was furloughed from the hotel that she worked at in hospitality. She's got her 80%, but now she's the same. She's working in a supermarket. Just to earn some money. So, but for her, it's not really about the money. While she needs the money, for her, she just wants to help. She wants to serve. She wants to give back. And supermarkets, they're all booming right now, obviously. So yeah, it's all good.
Yeah, well, very good. So good morning and good afternoon again, guys. Glad you're here with us. If you got questions, go ahead and load them up in the chat, or just say hi. We love to hear from you, and happy to have you here. So so Carl, flipping the side of the pond a little bit, over here we've got a couple of things going on. The biggest in terms of dollar value is the Paycheck Protection Program, the PPP, and not only has it been big in dollars, the first round of it was 349 billion. Congress has since passed a subsequent 310 billion. So we're effectively at 660 billion dollars of money and loans available for small businesses. There are requirements for the loan, and you know, the easiest thing to do is say, hey guys, the SBA has got a great site that details some of this stuff, but I do want to just walk through some of this. You know, it's determined it wants, you know, it needs to be a small business. So there's criteria the SBA has for that. Generally speaking, less than 500 employees and a few other bits. Not-for-profits qualify and things like that. But we've seen some unusual things here, right? And I'll get to that in a minute. But the overall loan program is this, in that you can claim 2.5 times the average monthly salary of all your employees, up to a cap of 100K per employee. So how does this work? So in 2019, if you have 10 employees, all making 100,000 a year, that's a monthly rate of 8,300 roughly per employees. So it's 83,000, 33, you know, threes repeating, right? So, and if you multiply that by 2.5, you get 208,000. So a business with 10 employees, all making 100 grand a year, could get $208,000 in this PPP loan. Now, what's important to note is this loan is going to be converted to a grant if used substantially for payroll. Guidelines on the SBA website say 75% of the forgiven amount must have been used for payroll. Payments are also deferred for 6 months. There's no collateral, no personal guarantees required, and neither the government nor lenders will charge the small business any fees for the loan itself. The program will fund the banks and pay them fees. Banks are making a good bit of money off the back of this in kind of processing fees. But the business itself doesn't have to fund those fees, and that's an important thing to note. You know, I've been talking to a lot of banks in the last month as we're doing deals and we're looking for financing and discussing options, and they're all slammed right now. They are slow as can be because they're slammed with the number of requests. I mean, lines out the wazoo, websites going down and crashing. That there's just so much volume. You know, I think Wells Fargo hit their 10 billion loan limit as a result of, you know, limits on them as a business, $10 billion. And then I think they hit it in 48 hours or something, right? So a massive amount of demand for these. And here's the thing, if you don't use the money substantially for payroll and it ends up coming, you know, you use the money for other purposes, the loan's got a 2-year maturity and an interest rate of 1%. So in a business that had $1 million of payroll, 10 employees, $100,000, they got effectively a working capital loan of $210,000 or so for a 1% interest rate, payable over 2 years with no payments for 6 months. So it's a pretty cheap working capital loan. However, this is where people are starting to get into trouble. And there's 2 things. One is we've seen a lot of businesses. I think the number is close to $1 billion, right? So if you think in the first round, 1/3 of 1% of the money went to publicly traded companies who gamed the system because of locations and otherwise, and were able to secure funding. You know, I don't need to name any of those big companies. Some of them have come out and very publicly been shamed and then have had to pay the money back. And I'm not here to dox them in any way, but important to note is there's some real expectations that this is to go to businesses in need, businesses that see economic interruption as a result of what's going on. And it's important there's a level to prove there's impact, right? You know, it's got to be used for, you know, the business is likely in some kind of economic uncertainty. So healthy businesses, growing businesses generally won't apply for this. And that's just, that's not to say they aren't doing it in big numbers. But, if I'm a business owner of a business that's growing and not seeing any limitations, I would probably not pursue this, albeit likely free or cheap money, if only because I'd be concerned with, any kind of red flags or punitive things. I did see anyone who's, I believe, received more than $2 million through the program will be automatically audited by the SBA. So any larger businesses, still qualified as small businesses, who have received $2 million or more in loans or grants will be paid. And if you think about it, $2 million, right? If the multiplier is 2.5, that means your monthly payroll is 800 grand. In a service business, that's a 10 million a year payroll cost. That could be a $15 million a year accounting firm. That could be a $20 million a year accounting firm. Something like that, a professional services business to even hit that level. And so those aren't necessarily massive businesses, and certainly businesses that are likely to be impacted in one way or another. But, important to know that anyone over that 2 million mark is likely to be audited. So that's the Paycheck Protection Program. I think there's a whole lot of concerns for people who are applying, how this works. Banks have been overwhelmed, like I said, so it's very interesting to see. And again, I certainly think it's been an overall good program, but I think there's definitely been limitations. Anytime there's a rush to put together big austerity measures like this, there's just going to be shortfalls in the deliverability of it, the ability to get to all the right people in the right time without people taking advantage of it. So anything certainly the government can do to weed out those who are kind of fraudulently or self-serving just by getting this money is, I'm certainly in support of those, because, if you don't need the money, there's plenty of businesses who won't actually get the money because there's a cap to how much will be given out. So I think it's important to try to reserve those for the businesses that actually need it and are seeing a decline in revenues. If your revenue is going down, I'm all for you getting it. There's no doubt about it. If your employees are impacted, I'm all for getting it. But if you're seeing none of that, I think, save it for a business who is suffering.
Great.
So let's see here, Carl. I think we got a lot of questions coming in. So, hey guys, happy to have you again. Let's see here. So before we get to some of our questions that have come in on the mailbag, we'll get to you guys who are here in the live. So happy to have you. PPP ran out of money, especially for the economic. So there's a disaster loan program. So in addition to, hopefully you've been able to pick up the second round of the PPP. That's all I can say there. But the biggest thing, is you're pivoting now as a business and you're thinking about using your business as an umbrella company for buying companies. I got no problem with that. What I would tell you, and talk to your attorney, is you generally don't want an operating company to be the holding company for your investments. Just creates liability cross-pollination, and you want to be careful of that. But listen, anytime you're setting up a holding company to go buy companies is a good step in my book, right? The more business you buy, the better off you'll be. So happy if you're moving in that way. Carl, here's a question for you. So Jim says, I'm currently structuring a deal for a cash-rich business. Total cash in the business is about 80% of my offer price. Can I use the existing cash as the closing payment in the deal? And if it's possible, how would I professionally inform the seller that this would be my funding of the closing payment?
Yeah, so great question. So a lot of this comes down to, when we talk about cash, there's the difference between the operating cash requirement of the business and the surplus cash that's sat on the balance sheet. And one of the reasons why, especially in the UK, not so much in the US, but like in the UK, it's a lot more tax efficient for a seller to take cash out of the business when they sell than taking it out in salary or dividends. In the US, it's not as not as
Yeah,
tax efficient. But
not as advantageous for sure.
yeah, but what's interesting is when you look at a business, we're buying businesses as going concerns. So we're buying them with working capital inside of them so we can continue to trade them. And when we normally look at a business, subject to a more detailed cash flow forecast as we're doing due diligence, but as we're making an offer, we want to see at least 10% of the annual sales revenues in cash on the balance sheet. Normally, we'll take 1/12 of the annual revenue. So if you've got a business doing 1.2 million a year in revenues, we'd want to see $100,000 of cash in that business. If that business has got $500,000 of cash inside of it, then that $400,000 you can use to help purchase the business. However, when you're valuing the deal, you need to add that surplus cash value to the value of the business. So let's say you're buying that business and it's doing 100 grand a year of profit, and you're buying it for a 2.5 times multiple. So you're buying the business for 250. If it's got 400 of surplus cash in it, then you're adding that to the purchase price. So your total offer to buy the business is going to be 650. You're paying 250 for the business plus 400 for the cash, but you can use that 400 cash as your closing payment and then pay the 250 in seller financing. So absolutely, you can use the surplus cash in the deal to help fund it. And then clearly, when it comes to negotiating with the seller, you're above board that you're buying the business and you're buying the cash that's already in it, but you're using the cash to close the deal. That's completely fine. In fact, Adam and I have just done that very thing with a business we've acquired in the UK. We bought an IT business, and our entire closing payment was the surplus cash that the seller had kept in the business prior to sale.
Yeah, and important to note is in the UK, it is very tax favorable for that situation. Entrepreneurs relief, which reduces the tax paid, on the gains of the business, to the point where it's cheaper for them to sell the cash than it is to distribute it to themselves as a dividend. So we don't have quite the same situation here in the US. So we don't see as many deals with that structure, but doesn't mean it's not possible. So in terms of talking to them, you just have to be upfront around, what your goals are with the business and the deal itself. So Money Cash, name of the commenter here, says, I don't have anything I'm particularly passionate about. My only real experience is sales, admin, and customer service. What kind of business should I try to buy first?
Okay, great. So the fact that you've got some chops in sales and marketing and customer service, customer experience, that in and of itself is what we call a horizontal skill set. So that's a skill set where you're going to be able to add value to pretty much any business, because any business, doesn't matter what it is, B2C, B2B, sells to the government, doesn't matter. There's a sales and marketing and customer service function. So the challenge you're going to have, though, is if you don't have any sector expertise, it's going to be harder for you to build a relationship with a seller and obviously build those relationships with financiers and other people that you're going to need to help you close the deal, like the CPA, the lawyer, etc. So my advice would be go and partner with somebody that's got some sector knowledge. If you're in the Dealmaker CEO program, go into the Facebook group and explain who you are and what you're looking to do. There'll be people in that group that have lots of sector knowledge, but don't have those horizontal skills that you have to add a lot of value to the business. And Adam, I'm thinking of Peter and Hanif when I say that. So there's two gentlemen inside of Dealmaker Wealth Society. They're in our Dealmaker Academy program, which is our weekly group coaching setup. And those were the exact same things. You had Hanif, who I guess Money Cash is just like you. He was a marketer, had no passion for a particular industry, had no sector experience. He partnered up with Peter, who was an engineer, who knew the engineering space very, very well. So those two people have come together and they've bought 5 engineering businesses. So Peter's leveraging his engineering knowledge, and Hanif's the deal maker, finding the deals, raising the finance, closing the deals. And then once they buy the businesses, he's adding his horizontal skill set, that sales and marketing chops, to add value to the business and to grow it. So that's what I would do. And just one other thing, when you say you don't have any passion for any industry, yeah, I'm going to call you on that. I don't think that's the case. Just think about your life. There must be things in your life that you're passionate about. Do you like wine? Great, go buy an online wine business. Are you passionate about education? Go buy an educational training company. Are you passionate about sports? Go and buy a supplements company, or go and buy an apparel business, or something. Look into your hobbies and your interests and the things that light you up in your life, and then there are always going to be businesses in and around that interest level. Go and buy one of those businesses, and go find someone on LinkedIn, or if you're in the program, go on the Facebook group, find somebody that knows that industry, and do a deal together with them.
Yeah, absolutely. So let's see, Empowered by Tommy.
Empowered by some great names today.
Yeah, found you guys yesterday. Started reading the book and watching the webinar. Very anxious to get started. Well, Tommy, we're darn glad to have you, and hopefully you continue your journey on to become a deal maker, frankly. And we're just thrilled to have you. Let's see, Chrome Clapper. We're just
we got some great names today. Chrome Clapper.
So SBA 7A loans. If I want to buy a business that's selling for 500K, $1 million in revenues, how much would I have to put up? So there's guidelines that the SBA has, and then there's bank-specific guidelines. So important to understand is, while the SBA 7A program is backed by the SBA, it's still underwritten and supported by individual banks. And every bank's different. They're going to have different collateralization requirements. They're going to have different down payment requirements specific to the individual deal. So I can't give you an exact answer for that deal because I don't know any of the information around it. That said, generally speaking, our experience is 10% of the total deal value. And again, big asterisks, it depends on the deal, right? So in $1 million deal, it's 100 grand. However, it all depends. So you're going to have to talk to the bank and get a little bit more specific around what they might need. Important to note is, with all SBA deals, you're going to have a personal guarantee. And if you yourself can't do that, this is where Carl and I always talk. Find a partner, find a buddy, find someone who you can invest with, who can support the personal guarantees. It's a diversification of risk. And hopefully you find someone who can add value to your deal making. This is someone like we were talking about, Peter and Hanif, where there's complementary skill sets. One's an operations person, one's a marketer, one's a sales guy, one's a technician, right? So depending on what each and every skill set is, the value of partnership is key. And Carl, as my partner, how's our value? How's our complementary skill sets? I think we do well. And so I think, off the charts. So I think, you've just got to make sure you go eyes wide open looking into it. But every bank's different. Every deal is different. We've typically seen 10% of the deal value, but all that is heavily, heavily dependent on.
And just one thing just to add about the SBA, don't be fooled when you go to a business broker site and the broker tells you that the deal has been pre-approved for the SBA. That is an absolute complete myth. The SBA process is really more art than science. There's a lot of different criteria that the SBA look at. They look at the business, they look at the volatility of the numbers, they look at what assets are on there, they look at the credibility of the buyer, they look at your credit score. If you're getting the down payment from somebody else, they want to know who they are and what value they're going to add. They want to know if you're going to go in and going to run the business. The seller has to completely exit the business, both as a shareholder, as an employee. So there's a ton of different things. And the vast majority of all that criteria has got nothing to do with the business. It's got to do with the buyer. So it's impossible for anybody to say a deal has been pre-approved by the SBA. There's a lot of things that go into the mix. And the only way to know is to go find a deal, negotiate a price, And then if you want to use the SBA, that we call that the lender of last resort. We'd much rather agree a deal where you can use surplus cash, you can use seller financing, you can use earnouts, or if the business is asset rich, you can get asset-based lending like receivables, real estate, plant and equipment, inventory, all those different things, or even go and get equity investment from partners, angel investors. The SBA is really the lender of last resort. And but yeah, those are the requirements. I know, Adam, there's someone in the program did an SBA deal, and this was Mike, and he got a 90% SBA loan, and the SBA allowed him to split the 10%, 5% him and 5% what the SBA call a seller standby note. So it's like a little tiny piece of seller financing that the seller gets paid only when the SBA has been fully discharged, say 10 years. So I've never ever seen a deal like that where there was only a 5% requirement to kind of go in. But you know, they do exist. But this was a pristine buyer, pristine business. It ticked all the boxes. It's probably the best deal the SBA had ever seen, which is why they relaxed the rules a little bit. But Adam's right. The requirements vary wildly.
Yeah, I mean, some banks will ask for a whole lot of things. Some won't. It just depends. I think Carl spoke about it already. Banks really put no stock in these, you know, pre-approval letters you'll see from brokers and things like that. You know, even if a bank's written it, right? So we have a situation with a deal where it was presented to us. Oh, this bank, someone we already have a relationship with, has done a pre-approval letter. Quick email to the bank simply says, we put no stock in those letters, and you shouldn't as well, right? You've got to evaluate the deal and you've got to judge it on its own merits, not because a broker says the SBA will do it, because that broker hasn't gone through underwriting, that broker isn't personally guaranteeing the deal, and that broker isn't actually responsible for paying for it. So just keep that in mind when you're evaluating things. Great questions today, guys. And again, we're happy you're here. So if you don't even have a question, just say hi. Love to hear from you. So Money asked you, Carl, about where to get started, that horizontal skill set. Well, Money likes politics and government, majored in poli-sci and has worked in government, just not sure what to buy in that. Well, the government outsources and privatizes so much. There's loads of private contractors out there somewhere that you can probably sink your teeth in. If you worked in government, you probably worked with some of them as vendors. So happy and hopeful that you'll continue on your journey for sure. So Jim's got another question, and hi David. Jim's got a question here. Can you take a 25% equity stake in a business, roll up several into a holding company, and sell to a corporate buyer? The answer is 100% yes. In fact, I'd strongly encourage you doing that. So what I would say is, listen, the more opportunity you can find that you can bundle together, the higher exit multiple you'll be able to do. I mean, it's plain and simple, no doubt about it. Just arbitraging the multiple game for sure.
Yep. And the great thing about that is you can actually do it as well without buying or investing in any businesses. It's called a paper merger. And if you're in the Dealmaker CEO program, I show you how to do that in the bolt-on acquisitions bonus training.
I've heard another term, a virtual merger.
Yeah, we call them paper mergers in the UK.
Yep.
So you basically find a bunch of businesses, you agree deals to buy them all, you then meld them all together in a business plan, go and pitch it to a big trade buyer. The trade buyer pays at the premium because they're all kind of as part of the same group. So let's say you find 4 businesses and all of the sellers will agree to sell for $1 million each. You bundle them all together in a plan, you take it to a big trade buyer, and they turn around and say, yeah, we'll pay you $6 million for this entire business. Then you just made a $2 million profit. Hard to pull off, complicated, lots of cultural challenges and things in there, but it's definitely doable.
Yeah, absolutely. And just because we said to do it, happy to say hi again to David. And a Bam. I'll just go with Bam. Sorry, Bamidel. Hopefully I said your name correctly, but great to have you here on the live, and thanks for saying hi. So Jim has offered to buy us a beer for us both if we meet. So
Yes.
I think we may as well call it a day right now. I'm in. But he's also mentioned he's interested in funeral services and security firms, and which industry would be better. I can't speak to which one would be better because I like both of them. I think we were talking, was it on the partner call this week or Academy call? I can't remember. But the subject of funeral homes came up in that industry in general. And did we not know that everyone on our call, those private weekly calls, did they not have enough puns for us? People are dying to get in, right?
Yeah, dying to get in. Yeah.
Dying to get in. You can make a killing, all sorts of things. But
yeah.
But listen, so I like both of those businesses.
Yeah. Both are very good businesses to own right now, I would say. And I don't mean that in a morbid way, but obviously funeral care businesses their revenues are growing right now, obviously, because sadly a lot of people are dying. But I think just generally populations are getting older across the world. So those businesses will uptick anyway. And what you tend to find with funeral care businesses is it's kind of an expense that it's not a very price sensitive business. You know, people want to take care of their loved ones, and they're prepared to splash out. And what I've seen a lot of the last 10 years is, you know, the growth in insurance services for that. So a lot of people are taking out insurance policies so they can afford really good funerals and for their loved ones or themselves. And obviously that's great, because it means if you've got insurance companies as big receivables in one of those businesses, that's an asset base that you can leverage. And funeral care businesses, big roll-up opportunity, because you've got the big chains that own thousands of these things, then you've got all these small little independent ones. You know, there's a job to kind of roll some of those up and then sell them up the chain to larger companies. So that's definitely something that I would do. And security companies, yeah, one of my buddies, Kevin, you know, he's an ops director of a big physical security company, and their revenues are triple what they were this time last year, because a lot of these empty businesses with furloughed employees, they're having to invest in physical security to kind of shore up, you know, those businesses. So both great opportunities. My question for you is, you know, which of those sectors do you know, understand, can add value to, are passionate about, and potentially have a network that you can leverage? Whichever one of those ticks more boxes, those are the deals that I would do. Adam and I are very big on staying in your lane, especially on your first deal. You know, do a deal in a space that you know. It's a lot easier.
Yeah, no, absolutely, 100%. And you know, just touching on security for a brief moment, man, that space can be fabulous with recurring revenues, MRR, monthly recurring revenues. And so you can see stronger multiples in that space as a result of retention around recurring revenues, and just great businesses to get into, you know, if you've got the expertise and the ability to work in and help scale. I remember I was talking to a broker, Carl, I think I told you this story, who was in this space. And he wanted to charge me as a buyer to even evaluate opportunities. So that was something first for me and new for me. So he's already making money on the listing, and he wants to charge buyers a fee just to look at listings. Wild. Anyways, next question's in here. And Faith, good to see you as always. It was indeed a pun fest earlier this week.
Yeah. Hi, Faith.
So let's see. Cross has said, thanks for clarifying on the SBA lending and preferred ways of financing. Great for the checklist as we research. So happy to learn from us. And where have we been all their life? Well, I don't know. Where have we been all their life? Doing deals. Anyway, so glad you can join. So David's got a question regarding the UK. When going for financing, if one of the directors has a CCJ, how much of an issue is that? Is there a good way to lower their equity? I'm not familiar with that, Carl.
Yeah. So when you say one of the directors, do you mean one of the directors in the business you're buying, or one of your partners that's effectively part of your buying team? It would depend. If one of the directors in the business has a CCJ and that director's leaving upon you buying it, then it doesn't make a difference. If you have a CCJ or one of your partners has a CCJ, then that could be an issue. And in terms of ratios, it kind of depends on the bank. You know, a very entrepreneurial bank like HSBC, you know, anything sub 25% would be fine. With some banks like the Cooperative Bank or Barclays or NatWest, they'll exclude those people from the deal. So anyone that's bankrupt is a complete no-no. What's interesting though with banks is if you're using the assets to fund the deal, so it's the business that's borrowing the money for you to buy it, not you personally borrowing the money, then things like your credit rating don't tend to be an issue. But things like CCJs and bankruptcies, you know, can be, because it's a physical red flag, you know, on your credit file. So those can be an issue. When you're borrowing money personally to buy a business that we don't recommend, or you're getting a bank to fund a deal and there's no security, so it's like a cash flow lend, a bit like the SBA, then in those cases you do have to sign personal guarantees. But the good thing about the UK is you can insure them. There's a very mature PG insurance market, so you can sign PGs and take out an insurance policy which the company can pay. It's typically 1% of the total amount of the PG. So if it's £1 million PG, £1 million PG, it would cost £10,000 a year to insure that, which means, you know, you're not taking any risk in using that capital.
Yeah, absolutely. Thanks for jumping on that one, Carl.
No worries.
So Jeff was a little bit late joining, so no worries, Jeff. Glad you could stop by. And again, anyone else on the call here, feel free to say hi. We love to hear from you or ask a question. He's asking, how has the financing of assets and debtor books been affected? Lower ratios? And the answer is, I don't know if lower ratios or things like that, but I think they're ticking the boxes a little bit more. They're moving a little bit slower. I think overall the loan market in general has just taken a big breath and just slowed down a bit. And a lot of it's because a lot of these lenders are also dealing with programs like the PPP or other austerity measures. And so it's important to realize that those are red alerts, crazy impetus on where they're spending their time and what they're working on. So it's just important to realize that they've got so much going on. But I think this is a short-term thing for sure. Let's see here. Cross-pollination again, as loves. He's in the program and loves it. Can you please talk about your experiences with other students in education versus online education? So brick and mortar versus online for first deals. I don't think it matters to us. Carl and I would be happy to own either. I think the biggest thing for us is to make sure the fundamentals of the business are a business we want to buy. So I can't tell you one's better than the other. I think every deal and every business will have to stand on its own to see if it's a good deal. In fact, I've got no problem buying both. And so it's more the fundamentals of the business that would drive our opinion.
You're absolutely right. There are two factors that are different between an online business and an offline business. So when you look at an offline business, typically speaking, those businesses are owned by older business owners, older people. So what you tend to find with that audience is they're more aligned to kind of the seller distress that we're looking for. So they're typically a lot more motivated to sell a business. It could be retirement, it could be burnout, it could be frustration, old age, sickness, whatever it is. So what we tend to find, and this goes back to the deal making tribe we always talk about, finding a distressed seller of a good business is one of the key things that you need to do. The other positive with a brick and mortar business is they typically have a lot of assets that you can leverage to get a lot of cheap financing in to do a deal. When you're buying an online business, and there's been lots of online deals closed from inside of the program, but typically with an online business, you have the reverse of those 2 points. So online businesses are typically owned by younger people. And as such, they don't have the levels of seller distress that you typically see. You still get burnt out, you still get frustration, you still get people that get bored and want to move on to different things. But entrepreneurs like that, they're less concerned about their legacy and safeguarding of employees and all those different things, which the older generation for brick and mortars typically do. The other problem with an online business is they very rarely have a lot of assets. The only real asset in an online business tends to be inventory. And the problem with inventory is, for online business, the business is probably headquartered out of someone's spare bedroom or the garage. All the inventory is sat in a drop ship facility, whether it's Amazon or Clipper or one of the smaller companies. And the problem with inventory, if it's not sat in your physical HQ location, if it's sat in a dropship facility, you can't finance it. Because if you have a business and you have a ton of inventory and it's sat in your own warehouse, you can finance it, because if you don't pay the money back, the financier has the legal right to storm into your business, seize the inventory and sell it. With an online business, they can't storm the gates of Amazon, look around the pick center, find your inventory and seize it. They have no legal right to do that. So the problem with online deals is you tend to only be able to fund them through a mix of equity investing and then get some leverage on that with a cash flow lend. And that's why you tend to find with online businesses that the multiples are higher, not massively higher, but higher than the average that you see for a brick and mortar business. But if online's your passion, go to all the online broker sites. They're all listed in the program. Go and look at a bunch of deals, and there'll be some in there that will tick all those boxes for sure.
Yeah, absolutely. Okay, so a couple of questions here. We can't necessarily get into the specifics of these, but it's talking about using your retirement, funds to buy a business. Certainly, there's a lot of vehicles out there associated with that. It's really a personal decision. In my opinion, you're robbing Peter to pay Paul a little bit, but we can't really dive into that too much without knowing specifics and all that other stuff.
Yeah, I could talk a little bit about it from the UK's perspective. So I'm not an expert on 401ks in the US, but in the UK, the government changed the legislation on pensions a number of years ago. So the vast majority of pensions in the UK, you pay into them and you don't get paid out until you're 60 or 65, or in some cases older. So what some deal makers have done is they found a way to leverage those funds to do a deal. Because they might be in their 30s and they've got some money in their pension pot, and rather than wait 30 years to get the money, they want to put that money to work now to buy a business and generate some capital, obviously, for them to do whatever they want to do later in life. And in the UK, it's called a SIP, an SIPP, a self-invested pension plan, and it's quite a
Yeah, we've got the same programs here for 401ks, self-directed IRA.
Needs to go via a wealth manager. They'll advise you on on how to do that. I've done that 3 times actually in the UK. But then what happens is when you sell the business, the money goes back so that your pension fund effectively becomes a shareholder. So the money just goes back to your pension fund.
Yeah, you can't pull that money into the current day. There are ways around that, but this is very much a talk to your financial advisor and see what they say question for sure. Linda's asking, and this is great, and hi Linda, glad you joined. SBA loans, personal guarantees, seems crazy to do that, no? That said, do investors really take on PGs for you? Are there bank loans with good terms that do not require PGs, and what are they? So I'll answer in reverse order. Generally speaking, traditional bank loans absolutely require PGs. The bank wants to make sure they get their money back. That said, if you are taking a bank loan, you're an existing company and you've got a ton of assets and things like that, you're 100% able to get around if you've got a really long relationship with the bank. Buying a business, you're not going to have that, so PGs are required. Do investors take on PGs for you? Yes, there's actually a PG market out there, right? There's people who have the financial wherewithal to PG, and what they do is they take equity in return for their personal guarantee. How do you find these people? You've got a network. There's no like listing site where you can find them necessarily. You've got to build your network, and these are going to be higher net worth individuals who are comfortable saying, listen, I'll personally guarantee the loan, but I'm going to require 40% of the business to do it. And I'm not putting any capital up. I'm just putting my personal guarantee up. So there is a market for these people because they get to own businesses, which is exciting for them without actually putting capital up. They're just using their overall financial position. So
and the bonus, Adam, of doing that is get somebody to do that has some chops in your industry. So if you've got the double problem, whereas you want to buy a business you don't know anything about, and you need somebody to PG a loan, find one of those people that will do it and knows your industry. You can leverage their expertise to buy the business and to grow the business once you've acquired it, but like an angel investor.
Yeah, absolutely. Let's see here. Stuart's asked, what contingencies should be considered if we're anticipating a major economic downturn? I think, Stuart, the biggest thing is know the business you're buying, right? I mean, this goes back to stay in your lane, which Carl and I talk about quite a bit, is if you understand the industry you're buying in, you're going to understand how any kind of economic uncertainty should impact that and your ability to pivot in that industry. How do you go from producing, whiskey to sanitizer, right? Like, how are you going in and figuring out how you can pivot that business? It's going to come from industry knowledge. It's going to come with industry familiarity. If you don't have one of those horizontal skill sets that Carl and I have talked about before,
yeah.
Biggest thing is go in eyes wide open. Make sure your deal sets up correctly for how you want to do the deal. And kind of have low expectations, high expectations, and does the cash flow support everything in between? So what happens if your revenue drops by 30%? How do you survive? What happens, post acquisition there? You've got to be able to have an understanding of that. And small businesses are surprisingly resilient if you run them effectively. And that most importantly comes down to capitalization. What I mean by capitalization is your ability to keep cash in the business and liquidity in the business for both growth, reinvestment, and for a defensive position against downturns in the market.
Yep. No, I absolutely agree with that. And I think that the key point in there, Adam, what you talked about was pivoting. And clearly you want to buy a business right now that's got the ability to pivot through this new economic change, but the seller doesn't want to do it. So you might find an engineering company that's making components for cars. Obviously not a lot of people buying cars right now, but can that company pivot and quickly enter the supply chain for the booming market for medical devices? I know someone that's doing that, and he's absolutely killing it. And then back to the deal structure, if you're concerned that businesses are going to have this downturn, then the instrument that you can use for that is called an earnout, which means that a good component of the deal price and what you're going to pay the seller in the future is contingent on that performance. So if the business drops, then clearly you're going to be paying less for the business because that earnout structure will kick in.
Yeah, very good. So Stuart, it's all about being defensive and really understanding what you're getting into. Let's see here. Linda's asked, following on to the PG, to avoid a personal guarantee, have you ever seen a deal with the seller for the buyer to join the company ahead of the deal and then do a no PG bank loan as part of the company? I've not seen it, but that's mostly because banks love personal guarantees, especially traditional loans. It's just, it's what they prefer because they're given security above and beyond the assets of the business itself. And anytime a bank can get additional security, they will never not take that opportunity. So that's their default. So I've not ever seen that, Carl, have you?
No. So what you're talking about is called a BIMBO, a BIMBO. It's called a buy-in management buyout. So there's three ways an individual can buy a company. If you work for the company already, it's called an MBO, a management buyout. If you're an external person, you're buying a business you've not worked in before, it's called a management buy-in, an MBI. If you go into the business first, do some consulting, get to understand it, then you buy it, that's called a buy-in management buyout. The rules on personal guarantees for unsecured lending makes no difference which structure you're using. What I would say, doing a BIMBO versus an MBI, it just makes it quicker and easier to do the deal. They might lend you more money, for example. They might give you a cash flow lend is normally on a multiple of the annual recurring free cash flow. It's generally it's up to 2.5 times in the UK. If you're doing it as straight MBI, they might lend you 1.5 times. If you're doing it as a BIMBO or an MBO, because they know you really understand the business because you're there, they might lend you 2.5 times. So those are the only kind of variables I see, but it doesn't make any difference on whether you sign a PG or not.
Yeah, again, banks just, they want PGs. They're born for PGs. I'll use a simple example, right? Say you're married, you buy a house with your spouse, you get separated, divorced, what have you, and you've got to refinance the house to get someone off the mortgage. The reason you've got to do a full refinance is because the bank, once someone's name is personally guaranteed on it, they're not removing it. They're not removing it, and they won't remove it. They just absolutely want, they want as much security as possible against as many people as possible for any kind of debt. So business buying is no different. So super exciting for sure. When you don't necessarily have the ability to PG, but that's what opens up that networking and opens up the opportunity to find an investor to come in and really juice your opportunity. If you guys aren't networking with people who can PG, who can provide investment capital, you're missing a big opportunity to accelerate your deal making snowball, to really accelerate your growth and the stack companies and one on top of the other. This week we were talking a lot about salary stacks, right? Where you're taking an executive salary at every company you own. And that's what we're talking about here, right? Is like, how do you get paid on so many companies? It's all about building a network and building a partnership. Because at the end of the day, Carl, you and I will always be thrilled to own 10, 20, 30% of a company as opposed to 100% of nothing, right? It's better to own something than nothing. And so what we see and what we fight for is for you guys to get involved at any level, right? And we teach that. Dealmaker CEO is the course for that. It's got everything you need. But listen, if you guys want kind of a preview, a snapshot, we've got Carl Allen's Business Buying Blueprint. It's a 10-step guide to get in there and really get started. It's free for you guys. There'll be a link below. And really, we're excited. We're excited for you guys to get started on your deal making journey. Because again, we want to own pieces of companies. And frankly, Carl and I, our goal is to build a massive portfolio of businesses, one really across the globe. And we want you guys to do the same thing. We want you to realize and recognize the benefits of business ownership, the freedom, the wealth creation, and really the life without a boss. And that's what so many of you guys are looking for. And if you're a business owner already, how are you expanding that business? By acquisition, or are you struggling with your marketing and your sales? Why not acquire your competitor and grow that way? There's so many great opportunities. So guys, thanks for today's YouTube live. Thanks for the great questions. Carl, we didn't even get to any of the questions we had ahead of time. So many great questions today.
Yeah, I think it's fair for us to reward the people that are showing up live and taking the time to be with us today. So yeah,
absolutely.
Yeah, if you're live and you're showing up, you're playing full out and you're asking your questions, I think we should do those first, and then if we have time, we'll do the ones that people have sent in. So yeah.
Yeah, I couldn't agree more, right? And so Stuart and Linda and Faith and everyone
Clone
else.
Crapper. What
Yeah,
was his name? Chrome Clapper.
Chrome Clapper
Hunting
and
Tom.
Cross
All these great
Pollination.
names. Love it.
Yeah, so happy to have you guys with us, and really we'll see you on Monday for Mindset Monday. Have a fabulous weekend. Remember, you are one deal away from changing your life. And so, if you could, before you go, like the video, share the video. We really appreciate it. And if you haven't yet, subscribe to Dealmaker Wealth Society, and we'll see you next week.
Yeah, see you Monday, guys. Have a great weekend. Keep crushing it, and we'll see you Monday. Till then, bye for now, guys.
Bye, guys.